I've been trading for 4 years now. And if there is one thing I have come to truly understand in this journey, it is that time does not matter in trading, direction does. And I say that from experience. Because in my first years, I was all over the place. I was chasing too many things at once: indicators, patterns, signals, drawings, you name it, I tried it. And it got so bad that sometimes I would open the chart and just stare at it, not even knowing where to begin. Not because I was not studying, but because I was studying the wrong things. I had too much noise and no real direction. But the moment I stopped chasing everything and started focusing on what actually mattered first, something shifted. The chart started making sense. I stopped jumping into random candles and started waiting for price to actually play out in front of me. And that one change made everything clearer. Now, the biggest mistake I see most traders make, and trust me, I made this same mistake, is that they are always trying to chase candlestick patterns and drawings instead of actually listening to what price is saying. Instead of asking what is really happening to the price right now, they are looking at a candle shape and trying to force a trade out of it. They are reading the surface instead of reading the market. And because of that, they never really understand what is in front of them. And then on top of that, a lot of traders are also chasing quick cash. And honestly, that is where the impatience comes from. So when you combine someone who does not understand what price is actually doing with someone who also does not have the patience to wait, what you get is a trader who is basically gambling, entering randomly, exiting emotionally, and blaming the market every time something goes wrong. And then there are indicators, which are not bad on their own, but when you layer them on top of everything else and use them as your main reason for entering a trade, you end up even more confused. Because indicators are lagging. They react to what has already happened. So now you have someone chasing patterns, rushing for quick money, and reading tools that are always one step behind the market. That combination is why so many traders stay stuck for years. All of this gives you results based on guesswork, not real understanding. And that is exactly what I want to help you move away from today. So what should you actually be learning? Here are the core concepts that gave me that clarity. The first one is liquidity. The market is always moving toward liquidity, toward where stop losses are sitting, where orders are resting. Once you understand this, you stop being the person getting hunted and start understanding why price actually moves. The second one is supply and demand. Not just drawing zones, but genuinely understanding why price leaves certain areas with aggression and why it returns to them. This is the backbone of how the market is structured. The third one is swing highs and swing lows. This is your market structure. Knowing whether the market is making higher highs and higher lows, or lower highs and lower lows, this tells you the story of what price is doing at any moment and keeps you from trading against it. The fourth one is order blocks. These are areas where large institutional orders were placed. Price tends to return to these zones and respect them in ways no retail indicator will ever show you. Combine this with liquidity, and you start seeing the market the way the big players see it. The fifth one is displacement. This is that strong, impulsive move that happens after the market sweeps liquidity. And what makes it so powerful is that it does not just tell you price moved. It tells you who is in control. When you see real displacement after a liquidity grab, it gives you a clear picture of where the market is actually heading. Without it, you are guessing. With it, you have confirmation. There are also other concepts worth exploring, things like SMT divergence, which I encourage you to search up and study alongside everything here, because they all connect beautifully once you understand the foundation. Now, once you have those core concepts solid, you move into the sub-concepts, the tools that sharpen your entries. The first sub-concept is fair value gaps. These are imbalances left behind when price moves so fast it skips a price range entirely. The market tends to come back and fill them, but a fair value gap alone is not a reason to enter a trade. What gives it power is the context around it. when it sits near liquidity, near an order block after a displacement. Use it to sharpen your entry, not as the trade itself. The second subconcept is the inverse fair value gap, or IFVG. This is what happens when a strong candle closes above or below a fair value gap, completely breaking it. At that point, the gap flips. What was support becomes resistance, and what was resistance becomes support. That flip zone then becomes a new area of interest for entries. It is not just a broken gap. It is a gap that has changed its entire role in the market. Once you understand all of this, then you can add whatever else you want on top. Your indicators, your drawings, your patterns. But now they will have real context, and your trading will start to feel less like gambling and more like an actual skill. That is what 4 years in this market taught me. Not a shortcut, just the right direction. If this resonated with you, drop a comment and tell me where you are in your trading journey. And if you want me to go deep on any of these concepts individually, just say the word. I will make a full video on it.